Welcome back. Let's take a look at exercise 7-8 in which we'll work with sales return. Let's first quickly read the information given to us over here and then see what's being asked of us and how we will do the exercise. So here we have a company that allows its customers to return merchandise for any reason for up to 90 days after delivery and receive a credit to their account. All their sales are for credit. The company began the year with a refund liability of $300,000, which means they expect $300,000 worth of merchandise from the 2023 sales to come back to them. During 2024, they sold merchandise accounting for $11.5 million. Their cost of goods sold is 65% of the sales. Also during the year, customers returned a total of $450,000 of sales for credit. 250 of those are from the prior year, and the remaining, that's 450 minus 250 is 200, is from the current year's sales. Sales return is estimated to be 4% of sales and recorded as an adjusting entry at the end of the year. So lots of information to unpack. We've been asked to do the journal entries for recording the sales that came back, the sales return for the prior year sales, the current year sales, do the adjusting at the entry of the year. So before we get to all these adjusting entries, let's first do the journal entries for the sales transaction. So during 2024, we sold $11.5 million worth of merchandise. We sold it for $11.5 million. That's the selling price. Our journal entry is accounts receivable debit, sales revenue credit for $11.5 million. Remember, they told us everything is a credit transaction, so accounts receivable debit. Now, these transactions have happened, multiple transactions throughout the year, but we're just recording it as one transaction over here. Now, corresponding to each of the sales transactions, we would also do a journal entry, which would be cost of goods sold debit, inventory credit. This is an adjusting entry you do after each sales transaction. And that's going to be for 65% of this sales price. So 65% of $11.5 million works out to $7,475,000. Now we are ready to work on our sales return. Now, before we do the sales return, let's take the information given over here. The company began 2024 with a refund liability of $300,000. So this account, refund liability, I have a credit balance of $300,000. This is the beginning balance that's given to me. I plug that number. I just put that number in over here, not plug it. I just put the number in over here. Inventory, estimated inventory account is going to be exactly 65% of this number. That's again my beginning balance. I've calculated it as 65% of the number that we have over there. Now let's take care of the returns that happen. We have the total returns are 450,000, but we're going to break them down into two parts, 250 and 200. The reason is because 250 related to the prior year's sales. So let's start with that. I had $250,000 worth of merchandise that came back to me. I had planned for this to come back. So my journal entry over here is going to be refund liability debit. I don't do sales return because I'd already planned for it. And remember, last year's sales return, the sales revenue account was already closed. So I have this refund liability debit, accounts receivable credit. And now I actually got the inventory. So inventory debit, inventory estimated returns credit. And that's going to be 65% of this dollar amount of the 250. And that's 165,500. It's 65% of these number of 250. So now that I have these two journal entries done, let me immediately put the numbers in place over here. Refund liability debit, 250. Estimated refund credit, 162,500. Again, 162,500 is 250 times 65%. So I posted these two journal entries only into these two accounts. I'm not concerned about any other account. Okay, now let's take a look at the remaining $200,000 that came back. Okay, the remaining $200,000 that came back. Remember, a total of 450 came back, but this 200 is from the current year sales. So I do credit accounts receivable. That part is going to stay the same. But the account I debit is going to be sales return. So note the difference over here. I'm going to highlight this over here for us. Refund liability debit 250, sales return debit 200. Last year's sales, I'm not going to debit sales return, but refund liability. I'd anticipated these returns to come. This year's return, since the books are not closed, I will debit sales return. Again, I have to do a second journal entry, but see the difference over here. Now, in both cases, inventory is debit because inventory came back. But again, here the difference is because the books are not closed for the current year, I credit cost of goods sold. Here I credit inventory, estimated inventory, because I had planned for that from last year. 65% of 200,000 is the number that we use here. That's 130. Okay. Now finally, we will do the adjusting entry part C to decide what the refund liability should be for the end of the year. So last sentence given over here, sales return is estimated to be 4% of sales and recorded as an adjusting entry at the end of the year. So let's do our side note over here. 4% of sales. Sales is $11.5 million. 4% of that number we expect will come back. Okay, how much of that has already come back? Here, this number, it's already come back over here, the 200. So I don't need to worry about that. The sales return, let me highlight this over here. Sales return of 200 has already come back, so I don't need to worry about that. So what do I need to be concerned about? 260. This is going to be my estimated returns, and that is the estimated returns is what I need to have as my ending balance. Once again, 4% of my sales, $11.5 million in 2024. My sales is $11.5 million. 4% of that I expect will come back. 200 of that already came back. So I need to do the planning for my estimated returns. Another 260 is going to come back. So I want to have a refund liability of 260 as the ending balance. I'm not going to do the journal entry for 260. And why not? Well, look at the T account. I had 300 as beginning balance. I debited 250. So if you do a subtotal over here, this is nothing but just a subtotal. So let me label that as such. Subtotal. So this is a subtotal over here, 200. So I have 200 credit balance. I want an ending balance of 260. So how much do I need to do the journal entry for? This number. This number is a plugged number. Plugged number means I'm just putting that in place over there so that I can arrive at the 260. I have 50 with me. I want 260. Therefore, I need to do a journal entry. I need to do a journal entry for the 210. So let's see what my journal entry is going to look like. I'll have two journal entries. So let me go ahead and highlight them all the way around here. Sales return debit. I'm expecting sales returns. Okay. So I'm going to debit 210. Refund liability 210. 65% of that is for this journal entry. 65% of that is for this journal entry. 210 times 65%. Now, refund liability, that number was already plugged there. We work backwards to come up with this number over here. Inventory, estimated inventory is debited 136. So let me put that number over here. Okay. So now let me take a subtotal over here. These are subtotals in the calculation of the entity account, or you could directly come up with the final answer of 169. This is my desired ending balance. Inventory, estimated inventory. Now let's do a final check. 260 will return to me. The sales return in the near future we think will be 250. 65% of that should be my ending balance. So 169, is that 65% of 260? And the answer is yes. So we did this correctly. Okay, so these numbers are all internal numbers that we are keeping with us, planning for returns when they come. And this is when they come into the next year. So the 2024 sales, we expect 260,000 of that is going to come back next year. And that's what the planning that we're doing over here. So with that, we'll move on to the next exercise.